morning, everyone, and welcome to Teachers Retirement System of the City of New York Investment Meeting, the at-home version. Today is April 2nd, 2020, and it is 10 a.m. Patricia Riley, will you please call the roll?
I will. John Adler?
Here.
Thomas Brown?
Here.
Natalie Green-Giles?
Here.
David Kaczynski?
Present.
Russell Buckley?
Present.
Deborah Penny?
Present.
Susanna Vickers?
Here.
We have a quorum. I'll turn it back over to the chairwoman.
Thank you. Okay, we'll start the public meeting with the passport funds. Mike Fulvia, will you begin?
Yes. Good morning, everyone. Everyone should have received their multiple emails, but there was one packet or PDF which included all of the public session materials, and everyone should have that. At the front of that section, we included the February flash report, which I'll just touch upon briefly, since these numbers will roll up into the full quarterly year-to-date numbers we review later. But you will recall from our prior meeting on March 6th that February was the beginning of all the volatility we started to see in the markets. That certainly showed up in the returns for the month. If you're looking at the flash report, what'll certainly jump off the page was the negative 8.2% return for US equity markets during the month. Developed non-US equity markets were down about 9% during February, and emerging markets, they protected a bit on the downside, but still down about 5%. So obviously those numbers will have a meaningful impact in the overall performance of the passport funds. And if you're looking at year-to-date numbers, they were about comparable to slightly negative beyond those numbers, given that January was roughly flat to slightly negative as well. So if we're looking in at the specific numbers for the passport funds, and I'll comment on a few of the market dynamics that were present in February, but also continued through March. And these numbers certainly had an impact. What we saw, generally speaking, was large cap stocks outperforming small cap stocks. So if you're looking at the Russell 1000 index, that was down about 5% in February, and small cap stocks down about 11.4%. The other thing we saw, which has been an ongoing theme, if you will, value stocks significantly underperformed growth stocks year to date through February. Value down about 11.8% if you're looking at the Russell 3, and growth down about 5%. So these will have a meaningful impact to the returns of the passport funds, including the diversified equity fund, which for the month of February was down about 8%. So slightly ahead of the US equity market, but a few basis points behind the hybrid benchmark, which was down also about 8%. And if you're looking at the overall results, you'll note that the defensive strategies composite did provide some down market protection during February. So it captured about 67% of the US equity down market with a return of about negative 5.5%. If you're looking further down the page, you'll see the actively managed composite that lagged for the month relative to the Russell 3000 index that had a return of about negative 8.8%. And again, the numbers I noted, or the comments I made earlier about the large cap, small cap dynamic and the growth value dynamic, those were very much present in the actively managed composite, and the tilts there led to a good portion of that underperformance. Within the international equity composite, you can see that though that was down about 8.4%, it did slightly do better than the international composite benchmark. So year to date through February, diversified equity fund down about 8.8%, and we'll provide some more input on specific performance in the preliminary update through March. For the balanced fund, you can see assets of about 400 million at the end of February. That fund was down about 1.6%. Again, you'll recall comparatively better than the other options on this page, given about 70% of that fund is allocated to short-term gov credit fixed income. Year to date, that fund was down about 1.5%. The International Equity Fund, again, mimics the structure of the International Equity Composite of Variable A. That fund was down 8.3% for the month, with a year-to-date return of negative 10.6%. The Inflation Protection Fund, that fund was down 2.5% during February and down about 3.3% year to date. Those returns slightly lagged the benchmark, or the fund's benchmark, custom benchmark over that time period. The Sustainable Equity Fund, with assets of about $250 million at the end of February, that fund was down about 5.6%, which was enough to outpace the return of the Russell 1000 Growth Index during February. And year to date, that fund through February was up about 1% relative to the benchmark. Below that, you can see that the two newer variable funds, each fund for the U.S. equity index fund is down about 0.7% for February, and the international equity index fund down about 6.8% for the month of February. I'll pause there and see if there's any questions. Yep, Robin?
Do you want to just comment on the tracking error between the funds and the benchmarks?
Yep. So the funds there, the international, I think you're referring specifically to the two variable funds that are comprised of underlying index funds. The performance at the total variable fund level is impacted, as you'll recall, from both the timing and size of cash flows during the month, as well as there's some very modest cash positions for portions of the month within those funds, as there's rebalancing going on between the variable funds, and that'll impact the relative results, particularly given the very small or modest fund size at this point. There's also some positive tracking within the variable G fund, the International Equity Index Fund, and we've talked about this in the past as well. There's some fair value pricing impact, and given the really heightened volatility we're seeing in equity markets with a lot of the trading happening in the last hour of the day in the US, there's some notable fair value pricing impact to these funds on a day-to-day basis, and that over the long term, that fair value pricing tends to wash out.
Okay.
So not hearing any questions, we can move ahead to March. If everyone wants to take a deep breath before we do that, feel free. But that begins on slide 15 of the same set of material that we were in. So everyone should have or be looking at the page with the title Preliminary Monthly Benchmark Report as of March 31st. So at a very high level, obviously there was a lot of volatility during the month of March. Anyone who's been following the news is aware of that. The US equity markets were down about 14%, roughly in line or slightly ahead of what we saw from non-US markets. The defensive strategies composite during the month was down about 11.2%. So capturing about 80% of the down market that we saw for the defensive composite, the defensive composite strategies benchmark. And the diversified equity funds hybrid benchmark was down about 13.6% for the month. So we'll get into a little bit more detail as we peel those numbers back further in the agenda. But we wanted to highlight obviously some pretty stark negative numbers. The calendar year-to-date numbers obviously more negative than that. US down about 20%, 21% year-to-date. Non-US developed markets down about 23%, and EM also down about 24%. Within the balanced fund, you can see the relative strength of the fixed income holdings there. The Gov Credit Index, the 1 to 5 year Gov Credit Index year-to-date up about 2%. And the global equity index within that fund down about 22%. All told, the balanced fund benchmark of a calendar year to date of return of negative 5.5%. I commented a little bit earlier on the dynamic between large cap and small cap in the US. You can see that show up here a little bit within the international equity fund benchmarks. It's a pretty consistent story. So if you're looking at the EFI index, I noted earlier that was down about 23%. By comparison, the two line items below that are both small cap indices. for non-US stocks, and those were both down about 29% during the month. So some notable differences between large and small cap. Those persisted abroad as well. I commented earlier about emerging markets roughly in line with developed markets for the month, and you can see all told the international composite benchmark down about 24% year to date through March. For the inflation protection fund, you can see the underlying strategy there, year to date down about 14.5%. Where we, what's driving that return? You'll recall that fund is comprised of a variety of different strategies, some of which have helped with respect to relative performance. Others have lagged. So that fund is comprised of inflation protected bonds, levered loans, bank loans, mortgage, a couple different slices of the REIT market, so both REIT equities as well as REIT debt, and commodities and commodity-related equities. So you can see there that fund all told down about 14.5%, a little bit better than straight equities given the level of diversification, but nonetheless still a pretty notable negative number for the month, or year-to-date and month. The underlying strategy for the sustainable equity fund, that outpaced its benchmark by a little over 1% for the month, pretty similar to what we saw in relative performance terms during February. All told, that fund is ahead by a couple percent year to date. And then again, just below that, the underlying returns for variable F and G, the index funds. You can see those funds roughly in line with their benchmarks for the month and year to date. So I know we kind of glossed over a lot of what was going on in the background with markets, and so we wanted to spend some more time than usual taking the board through that as we work through the rest of the public agenda. And there's a lot of materials behind this on that. We're happy to certainly address or answer any questions that folks have. Otherwise, we can start to go through the materials and talk a little bit about what we're seeing with respect to the markets and some of the economic indicators that that have been in the news of late.
I just have one question before you move. All right.
Sure.
That's my question. Thanks. All right. On the sustainable fund, it really remarkably outperformed the broader equity indices. Any explanation of that?
Yeah, so this fund, you'll recall, has a bit of a growth tilt, and what we've seen, broadly speaking, is that growth has done notably better than the rest of the market. So it's not surprising that we've seen this fund do better compared to the broad market. It's also outperformed the growth index, which we're happy to see as well, even though the growth index has done better than the broad market. So I think we haven't yet started to peel back specifically what's going on there, but one of the things that folks have been talking about in the market, it's a current theme and one that I think we're going to explore together further, is how a lot of companies in some of the traditional value sectors, so if you think about oil and gas producers and the energy sector, there's a lot of questions about whether or not those businesses are sustainable looking forward, given the stresses on their business today, given the outlook for supply and demand in energy markets. And so that's an example of one of the themes where we're seeing and maybe questioning how realistic is that some of these businesses, which are especially challenged by what we've seen going on in the markets over the last month, how able are they going to be to sustain themselves looking forward if we continue to see not only the continued stresses, but was this the type of catalyst that maybe forces the world to evolve? And so that, what we've seen, and you think about the holdings in those funds, those growthier companies have generally done a lot better than the value stocks where there's a lot more pressure. I guess the exception to that would be the financial sector, which is also part of the value benchmark and has done really poorly. There don't seem to be the same types of concerns with financial companies at this point, but financials have also been beat up quite a bit more than the benchmark, and you'll see that show up in some of the manager numbers we're going to talk about a little bit later. There's less concern about the long-term sustainability of financials in this crisis or this market as there were back in 2008, 2009.
So the answer is
Thank you.
Brown has done very well for a long time through stock selection and the fact that they're a growth manager, and that pattern has continued. And the real question that Mike is talking about is, you know, we've been looking for a bounce back from value for years now, and the question I think that deserves to be addressed is whether there's some structural issues with many of the industries that are heavily weighted in the value benchmark. And that deserves much more, not ready to declare that value is dead, but you know, there may be very fundamental structural issues with some of those sectors. Should we
Thank you.
move on to the market deck? Or are there other questions?
Seeing none, yep, I guess we're good.
Okay, great. So as Mike said, what we tried to do in this market update, I'm sure all of you have been listening to news for many hours a day, and what we tried to do is select some of the highlights or lowlights, and both at the macro level and at the asset class level. This deck is not about managers. I will say that one of the things that Rokutan is working on to deliver in the very near term is some indication about how active management has done in Q1. There's a lot of the data that's most immediately available is mutual fund data. So we'll be looking at the mutual fund data as a proxy for how active managers have either managed or not during this crisis. So if we start, this should be slide 17 in the deck Mike sent out. And so what you can see here is both some actual results as well as projected results in terms of real GDP annualized quarterly growth. And there's a lot of numbers on this page. I think the point here is really to emphasize that the sharp decline that is expected to be reported for Q2. The solid red line is the current forecast, and what we're showing here is Goldman Sachs's forecast. And the dotted red line was their previous forecast just a matter of weeks ago. So you can see that the depth of the decline was originally, I think, understated. And they're forecasting a pretty sharp rebound in Q3 and then a rebound in Q4. Obviously, no crystal balls, and the jury is out about the length and depth of the decline, and we're all waiting, and you know this as well as anyone else, to see how the medical crisis is resolved. So with that, what I'd like to do is turn to the next page and talk about interest rate moves and Fed actions. So on the right-hand side of this chart, you see a listing of all of the actions by the Federal Reserve, the response to the crisis. The most important thing I think to note is that the Federal Reserve has moved very quickly, much more quickly than it did in 08, and so we can see that there's been a lot of very significant actions set in motion, including $700 billion in quantitative easing, all sorts of liquidity provided to money market funds, to small businesses, to the municipal market. And you can see on the left-hand side the decline in rates over the past several months. And today, the 10-year bond yield is at about 60 basis points. A year ago, that figure was close to 2.5%, and the long-term average is north of 4%. So, as I'm sure everyone has observed, a dramatic decline in Treasury rates. If we turn to the next slide, I'm going to keep going unless I hear any questions. And I know Mike and Alex are on the call, so if they have anything they'd like to add, that I welcome any comments they have on any of these slides. So we wanted to include a slide on global oil, on the global oil market, which is, of course, a very important factor in what's going on in the global economy. And this slide focuses on global oil demand destruction resulting from COVID-19. I'm sure you all know that simultaneously there's this price war that's going on between Saudi Arabia and Russia, which has exacerbated the issue. So on this slide, we note that price of oil has dipped below $20 per barrel. Today, it's, I think, about a little north of $20 per barrel. But there is some discussion of whether oil prices might in fact go negative as storage becomes overwhelmed and producers actually pay buyers to take the oil off their hands. So that's a possibility, just as yields have gone negative outside of the US. There is always a risk that oil prices could go negative, but this is an incredibly important event and metric going on in the global economy, and it is driving enormous change in the US oil industry, particularly among shale oil producers. And we think there will be very, very significant change in that industry as many of those businesses which are fairly highly leveraged and cannot produce profitably below a price much above $20 a barrel will be forced out of business. That in turn will have a significant impact on the high yield market and elsewhere. If we turn to the next slide, slide 20, on the bottom right-hand side of this slide, you see the same performance numbers that Mike's already gone through. So I'm not going to focus on those. I did want to focus on volatility, which is on the top right-hand side of the slide. And you can see the VIX, which is a measure of equity volatility, which in March went up slightly higher than the peak we saw in 08 and 09. So enormous volatility. Everyone has seen that day to day, but this is a visual reminder of that. We're looking at the US equity market through a slightly different lens on the next slide. These are historical drawdowns. So what this chart displays is downward performance of the S&P 500 going back many years. And you can see that the market has not declined to the levels that we saw in 08, 09, or even in 02. But we're moving in that direction. So this gives you some historical context for the US equity market decline that we've seen. And what this seems to indicate is that there's a potential for a continued significant decline. We've now, if you look at the table at the bottom, I think it's sort of interesting. We're now in the mid 30%. Call it 34, 35% drawdown. So from peak to where we are today, in the 07, 08, 09 timeframe, you saw a drawdown of 55%. So lots of happy news. If we go to the next slide. Now we're pivoting from equity markets into fixed income sectors, and we've talked about yield, the Treasury yield curve and movements in the 10-year Treasury bond. But what that doesn't adequately describe is what's going on within fixed income sectors, and there's a very wide range of outcomes among those fixed income sectors. So as you know, we we talk about the spread versus treasuries. And we can see the performance for different fixed income sectors for the month of March, as well as calendar year to date for all these different sectors. So you can see treasuries. This is across the spectrum of treasury maturities, up 8% for year to date and 3% in March alone. Agency mortgage backed, similarly positive return, and for the year to date and the month of March. And then as we go into other sectors that take credit risk relative to the US government sector, you can see that we have an increasingly negative return for both the month of March and the year to date. And so sectors that have quality concerns such as US high yield, you can see very negative returns. So for the year to date for US high yield, down almost 13% and 12% in the month of March alone. And I'm sure there'll be more discussion about this in the executive session when we talk about the pension fund. So with that, I'm going to turn to the next slide, which talks about a related, we just talked about performance relative to treasuries for the fixed income sectors. Now we're talking about widening spread, so the differential between yields in different sectors versus similar maturity treasury bonds. So you can see this peak in the early days of the month of March of the high yield sector, where the spread relative to treasuries rose to almost 2,000 basis points from a spread of about 500 basis points at the beginning of the month. So really dramatic changes within different fixed income sectors. And you saw these, we're reporting spread movements, but in many cases you couldn't even trade at these levels. Liquidity was so constrained. So again, another measure of volatility in the markets, this time volatility in the fixed income markets. I think the slide at the bottom of the same page is interesting. It talks about market yields in different fixed income sectors. So here we talk about what yields were for different parts of the fixed income market at the end of 2019 and at the end of March 2020. So we talked already about the significant decline in the 10-year bond, down from a level of a yield of almost 2% at the end of 2019 down to about 70 basis points at the end of March. You can see for corporate bonds, the yield rose about 60 basis points. For again, as we go down the quality scale down to high yield, we see yields, and this is for the broad index, rise from about 5.2% at the end of 2019 to almost 9.5% at the end of March. So dramatic movements, particularly for a lower quality. The next slide talks about private markets, and this is a lot of text, but the reality is we won't know what the full impact is for private markets for several months until their mark-to-market are actually reported. For private equity, that could be, we might not see that result till August or September. And again, a lot of text here, very limited new deal, no surprise, very limited new deals being closed in private equity and real estate, and a lot of focus on cash flow of existing properties and businesses and trying to manage leverage. And with that, my comments conclude. I'm happy to talk about anything in specific.
Okay, anyone else have anything else for public session? Okay, seeing not, then do we have a motion to move into executive session?
So moved.
Thank you,
Tom
Mr.
Brown.
Brown. Do we have a second?
Second, Susanna Vickers.
Thank you, Susanna. All those in favor?
Aye.
Aye.
Any opposed? All right, great. So we're going to move into executive session now. Do we have a motion to move into public session?
So moved.
Thank you, Mr. Brown. Do we have a second?
Second.
Okay, thank you, Ms. Vickers. Okay, we are moving into public session.
During executive session, a number of managers and portfolio issues were discussed. No action was taken.
Thank you, Thad. Do we have anything else?
Do you want to make a motion?
Do we have anything? Okay, great. Do I have a motion to adjourn?
Motion to adjourn. So moved, Susanna.
Oh, okay, that was Suzanne. Okay, thank you. Do we have a second?
Wait,
Second.
hold on. That was Susanna and Tom? Who was that?
It was Susanna and Tom.
Okay.
All those in
Bye,
favor?
everybody. Have a good day.
All right, all those
Right,
in
we
favor?
didn't vote
We didn't
yet.
vote. All
We
those in
didn't vote.
favor?
Aye.
Aye.
Thank you. Any
Aye.
opposed?
Aye.
Okay, we are adjourned. Stay well, everyone.
You